Hey traders, Raghee here, and in this recap video I'm going to walk you through something that we spent quite a bit of time talking about. In fact, we kind of put on a 30-minute little mini clinic this morning in the chat room, and that is how I choose what my directional bias is. And directional bias is very much linked to understanding market trends or market cycles or market phases. They all mean pretty much the same thing, and they take you back to something that Charles Dow talked about 100 years ago, and that was that the market has 4 distinct phases. And in order to understand how best to trade the market, you need to understand which one of the 4 the time frame and the overall daily time frame also is in. So if you're trading a 1-minute chart of, say, the Russell, you still need to know what phase this market is in. Which one of the 4 is this market in? When you're trading any market, it's best to understand what phase even the daily is in. Even if your interest is in a 1 or 3 or 5-minute time frame, you want to understand what the majority, what the bigger psychology is, the bigger picture psychology. So let's talk about this as it pertains to what I have kept as a fairly bullish bias on equities. And I know a lot of folks have different feelings about what equities are doing and why. I think the why is pretty easy. Let's tackle that first, not the what. Why? We have the trade wars, right? And we're kicking off another leg yet of the trade wars. This one is the U.S. tariffs on Chinese goods amounting to about $35 billion that's going to be enacted in about 6.5 hours here from the time that I'm recording this video for you. And so the market knows this is coming. They know the amount. They also have a pretty good idea of what the Chinese retaliation is going to be. So it's a lot of bad news, but it's a lot of knowns. We kind of know what the bad news is, and we've already braced for it. Now, how do we know that? Well, the markets have already sold off in response to the fact that we knew this was coming. This wasn't like we were told this morning that there's going to be $34 billion in tariffs and at midnight tonight. No, we've known this for days. So if not the better part of weeks. So this is how discounting works. We know there's bad news coming, and we rally or sell the market off in response to what we know. So the idea that the market could rally on a day like this is, obviously perplexing to some, but not when you look at the fact that we've already spent probably most of June at this point moving lower. So you want to remember that not all index futures, when I'm looking at Dow, S&P, NASDAQ, and Russell, not all of them are equal in my bullish or bearishness. I am extremely bullish small caps, bullish small cap energies, bullish the Russell. In fact, today we had a nice buy in the Russell and took it for a nice ride from the 1668, 1665 area right up into the close where we tagged 1685. So really nice move there in the Russell. Why would I be long the Russell? Because small caps, trade wars, and a strong dollar are a good mix for bullishness. Also, after the Russell, I've also been quite bullish the NASDAQ. I'm not looking to say the NASDAQ's going to rally to reinvigorate the former uptrend, but when I'm in the lower part of the chop, which is what this area would be, just like we're nearing the top of the chop up in here, right? But when I'm in the lower part of the chop as opposed to the upper part of the chop, it's easier to be bullish off around that 7,000 area. And increasingly, it's tougher to be bullish up around this 71.25, 71.50 area. So this is what chop is like. Your sentiment shifts are often going to happen at the edge, but it's easier to be a bull in an oversold market, and it's easier to be a bull in a market that's going to not be as susceptible to the big concern the market has, which are tariffs. Now, I can't say the same thing about the Dow. The Dow is actually a little easy to buy around 24,000. It is an overextended low that is acting as support. But the Dow, generally speaking, is going to be when there are tariff concerns, selling the market off. I'm going to be focused on the Dow. That's going to be where I believe the best opportunities for shorts are going to be, not the Russell. And as the Dow heads lower, it's likely going to then drag the S&P with it. And if the S&P gets dragged down with the Dow, it's likely then going to drag the NASDAQ with it. So it's understanding which dominoes fall with which narrative, and then which markets tend to fall when one starts to sell off. And in this case, how can the Dow instigate weakness in the NASDAQ? It's really through the relationship and through literally the S&P. So if I'm bearish, I'll focus on the Dow, and then I'll focus on the S&P. If I'm bullish, I'll focus on the Russell, and then I'll focus on the NASDAQ. So this is where I can choose how and where to be bullish. And generally speaking, yes, I do think there's a certain amount of expediency, political expediency, to at some point wrapping up these trade wars, because as we approach the midterm elections, the Midwest is going to be hit hard by the very targeted Chinese tariffs. And let's face it, the Shanghai index is down 25%. That's a mind-boggling number. And it's going to be in China's best interest to start to stabilize that part of their economy as well. So it's in both countries' interests. It's just that who's going to flinch first? Or do they just somehow extend olive branches to one another and can go back home a hero to their respective countries? And I think that's going to happen. The timeline, though, continues to get tighter because of midterms. And that's what I'm making the big bet on. So in the premium video, we're going to talk about what's happening in crude. The 30-year, we're getting very close to a 30-year trade in the 30-year. We're going to talk about the yen, talk some more about the Russell and silver, and then a number of heavily weighted names within these stock indexes, with particular attention to some of the financials like JP Morgan, markets that sold off early today like Amazon, and what that means to consumer discretionary and to tech, and what that means ultimately to the NASDAQ. So we got a lot to talk about in the premium video. I'll see you there. If not, I'll see you in the next update. Hey, before I forget, and I'm going to talk about this a whole lot more in the coming days, but we have our Simpler Summer Series available, and we're going to be kicking this off. So for the next handful of weeks, every Tuesday, you're going to have a lab, and then on Thursday, you're going to have a live trading session. So you get some instruction on Tuesday, get to see it put to work on Thursday. And we have actually 4 different labs that we're doing. And Carolyn's going to be doing one with Fibonacci. Henry's going to do one with options. Bruce is going to do one with options. And I'm going to do one, you know it, and it's going to be about day trading and price movement ranges. So what you can do is either look at each topic and find out which one is right for you, or you can go ahead and sign up for all of them and get a great lab and then live trading session, one every single week, which during this time of year is a great time to, revisit your education and think about what type of asset classes you might want to add to your current trading approach, which is something I love about what we do at Simpler Trading. We tackle all sorts of asset classes, and in this way you get a nice 2-hour class and then live trading, and it's something that you can build upon throughout July. So I'm really excited to bring you more information about this in the coming days, but wanted to let you know you can check this out over at simplertrading.com/summer.